All right, everybody, thanks for joining. We will be going live in just a few minutes. We're letting everybody get logged on and join. And so you will see us back on here in just a couple of minutes. All right, Greg, we're live.
Awesome. All right, cool. Hey, everybody. Thanks for being here. We're keeping this on time, but I'm gonna dance and banter a little bit because we got people that are coming into the show here, and give them all a moment to get acclimated. Hope you had a great week. Hope you're wrapping up a productive one, and I hope you have some great plans over the weekend.
All right, great.
Oh wait,
we're live.
and that's me.
Awesome.
Not being good at what I'm doing. Okay, so cool.
Come on, Greg, get it together. Get it together.
I've got it together. So this is a new show. We call it a show because we're intending to create entertainment value here best we can. If you're a real estate junkie, then hopefully you'll find some entertainment value in this. We joke a lot around here about how, at least in my case, I don't have any hobbies. This is pretty much, this and my family is pretty much what I do. And I really enjoy the folks that I work with, and I enjoy the product and the asset class and the people that we have a chance to engage with. And we're going to try to add a lot of value today. Picking Winners is the name of this show. This is episode 1. We're officially live with something we're going to do on a weekly basis now going forward. And the mission of Picking Winners is to seek out unique investment opportunities around the country. We have the benefit of having a team around the country that is always engaged in an intelligence gathering effort to try to find those nuggets of information about markets that are turning on. And so there's a philosophical approach that we take to this that I want to share with you. And then I'm going to dig into a couple of different markets with you on the screen here. And then Noel's going to be jumping in and actually sharing specific product with you. So this is an actionable intelligence approach here. And the philosophy that underlies it all is this idea that you're investing in American real estate. You're technically buying small pieces of this country. And where is more important than what? Okay, if you think of this and you include the dimension of time in the way that you look at it, like I buy property, I hold it for 20 years, right? That's my plan. So I have the opportunity to view this through the prism of how time impacts it, and where I buy is more important than what I buy. What I buy is obviously important, right? I'm not saying which house you choose is not relevant. But what Picking Winners is about, and what certainly today and probably most of our shows going forward are, the what is a brand new home. We're going to examine the where. We're going to share intelligence that we've gathered, some of it data-driven, a lot of it research-driven, boots on the ground, people in planning board meetings, learning about expansions of certain parts of these suburbs around these cities in the U.S., and sharing that with you, and then bringing it down to the granular level where there's actually brand new homes available to purchase right now in the markets that we're talking about. All right. So when I say where is more important than what, the idea is find markets that have what I like to call lift. What's lift? Upward pressure on values and upward pressure on rents due to population trends, migration patterns, demographic trends, things that are shifting in the economy that create demand in places and elevate demand in places, thereby pressing up values and rents. And if you can learn how to view the, sorry, phone's blowing up. If you can learn how to view the path of progress here, if you start to see the shifting plates of earth and where people are going and why they're going there, and you get confident enough that you can get out ahead of that, you make investments in places that are already popping but about to pop even more. So that's what picking winners is about. So I think we're good to go, Noel. If you, by the way, I'm Greg Rand. I'm the Chief Strategy Officer at Renters Warehouse. Noel Christopher, he's the Senior Vice President of Portfolio Services at Renters Warehouse. Say hi, Noel.
Hello, 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 everyone. Thanks for joining. Really appreciate you being here. This is going to be a great show.
Yep. Cool, man. So let me go ahead. I'm going to share my screen. I'm going to start bringing you through this journey of what we've got to share with you today. So my face is going to go away. I know how disappointed that makes everybody. And here comes the screen. So, hey, Noel, what I'm getting on the LinkedIn Live on my phone is the screen that we started with. So just you're aware of that. I don't know if you're seeing the map of the U.S. yet or not. Sorry, folks. LinkedIn Live is tricky. So am I. Folks, if you're in the live session here and you see a map of the United States, can you just say so we know? Okay, so what you're going to see in a second is a map of the United States, all right? And that reinforces what I was saying before about how we view this, that the product that you're investing in, the investment category is the United States. And I'm not being philosophical or fluffy about that. You're technically getting a deed to a piece of it. And the pursuit that we are after as investors is to accumulate as big of a footprint of this country as we can. Okay, as big of a footprint of income producing quality property. Renters Warehouse is a national property management company that is also in the business of, wait, I'm seeing your face on the screen now. I'm going to assume that this is all going to end up feeding in real time. Okay. Got it. Okay. So I'm actually going to put this down and ignore it. So yeah, you can buy the United States. Great idea, right? So we're going to be focusing on Houston and Birmingham today, but one of the things that we look for as a starting point to try to find these places that have lift is you look at a metro area, any metro area, and what tends to happen is that within the city center, that's where the city began, right? The city center is where it all started, and then you have these concentric rings. Usually, you have a beltway going around it. Then maybe a second ring of highways around that, and you could see from a shot of Google Earth here in Houston, you can see just visibly where the population growth has been, right? Where the density of population is, where the development has been more dense, and it doesn't all. It's not like you're dropping a pebble into a pond and it just ripples out evenly. It ripples out, but it ripples out unevenly, right? Suburbs develop at different paces from each other, and so no matter where you go in the country, you'll find the parts of that MSA, that metro area suburb, that are more expensive than others, and you can sort of figure out why, right? I grew up in New York. New York's a city that's been around for a long time, so I've been able to see this played out over a 180-year period of time as we really study the way New York developed. But suburbs that are the same distance from Manhattan are vastly different in terms of the values and the rents of the real estate, and it has to do with the branding of those markets. Westchester County as a brand. It has to do with mass transit and transportation into the city. It has to do with the way these places were developed and when they were developed. And what it presents is an opportunity that you can look at Houston and say, where's the late bloomer, right? Where are the places that are going through changes that are going to give me that lift in the future? So we spent some time with Rich Drake, who is our franchisee down in Houston, a real estate junkie extraordinaire. And he shared some things with us. We went down, we visited, and I'm going to show you now what we learned. So most people understand that Houston is very dependent on the energy industry. Biggest chunk of its employment base is in the energy industry. Sometimes people think that when oil prices drop, which they have, and when therefore gas prices drop, and when therefore the energy industry is going to go through a contraction, that cities like Houston are in for a really tough time. Now, that has not actually happened. I've seen the Houston Chronicle predict that Houston was in for it a couple of different times over everything from energy industry contraction to hurricanes coming in. It's a very, very resilient city. But the contraction of the energy industry did cause some shifts. And so if you look at this map right here and you look directly west, you're going to see what is commonly referred to, it's known as the energy corridor, all right? Energy corridor is where a lot of the businesses and therefore a lot of the employees went west of the city. And as the industry contracted and as jobs were lost, one of the things that happened was that ExxonMobil, hugest energy company in the world, heavily based in Houston, they consolidated. All right. So the headline is Houston's in trouble because of energy industry contraction. The subheadline or someplace deep in the article should have been really understanding what that meant. And what it meant was they were building a new campus. Okay. ExxonMobil back in 2015 launched a new campus in Houston up here in the Woodlands. All right. So you see this pin on the map up here. The Woodlands consolidated employees from facilities all around Houston, took employees and employment away from facilities in the energy corridor, brought it up here, but also brought people like ExxonMobil closed facilities in other parts of the country too. And so a story that was supposed to be bad for Houston ended up being very, very good for the suburbs north of Houston. This facility it holds 10,000 employees. Again, energy industry employees, so relatively high-paying jobs. It's still within reach of Houston, but what you can see is that as I scroll back again, you can see the Woodlands is kind of outside that second ring, right? You got the first ring, then you have the second ring, and it's on the outside of the second ring. The Woodlands used to be, quote unquote, in the middle of nowhere. And part of what our pursuit nowadays is finding those places that are in the middle of nowhere now, but are about to be in the center of somewhere, right? All right. The sprawl is making its way out. It's expanding into those areas. And when you have an anchor like ExxonMobil having 10,000 employees, what it does is it activates places around it and even further away. So I call this a suburban two-step. Mark Fleming, chief economist from First American, who we interviewed last week on a show like this, called it the grasshopper effect. I like that too. Grasshopper effect is in Houston, the jobs are here in the center. And then all of a sudden the jobs start moving out to the suburbs, and the people that used to live, in the suburbs, now the suburbs go further out. So people are willing to commute a half hour. They go a half hour out from the center, then the job moves a half hour out, and they move a half hour further than there because you get a better deal, right? Cost of living, quality of life, more room, more space, bigger house for the money, oftentimes lower taxes. So what this grasshopper effect here did in the Woodlands is it activated Conroe, Texas. It activated Cleveland, Texas. It activated something over here called Valley Ranch. Okay, I'll touch on that in a second. So first point is we have an anchor north of the city, and that anchor is now creating a gravitational pull of population in that market. So now what's interesting about Cleveland and Conroe is that they're in Montgomery County. At least Cleveland's in Montgomery County. And big parts of this county were dry, meaning they didn't serve alcohol. Right. And so one of the biggest trends about any town in America is the food trend, right? The brewery trend, the fact that these quaint downtowns that are in the middle of the Carolinas and Texas, all over the country, these quaint downtowns were turning into foodie culture downtowns, but it wasn't happening in the Northeast trajectory outside of Houston. Again, you look and you see the population density. If I start here at 12 o'clock and I go counterclockwise, population is dense. It's dense all the way around, all the way till it touches the waterfront. Then the northeastern trajectory is more rural still. So there's your late bloomer, the northeast trajectory. All right. And so they lifted the ban on alcohol sales. Boom. All right. And so what happened immediately is that restaurants began opening. There wasn't much of a restaurant scene, as you might imagine, in a place that can't serve you wine with your dinner. Right. And then, or whiskey with your burger, or beer with your wings. Right. They didn't have it. And so they were missing something that was keeping population from migrating there. That's what's changed. And the combination of these two things were a bunch of employees coming up to the tip top north of the city to work, now giving them access to places like Conroe and Cleveland, where there's a quality of life and a cost of living and an upgrade in the nightlife because of the foodie life. That's as simple as it is. Those are the things that are going to give these markets lift. And so if I showed you real quick, let me just give you a quick glimpse at a quick analysis I did here. Here are two charts that come off of, in this case, I grabbed them from Zillow because they got down to the granular level and helped to illustrate a point. The green line is when the Exxon campus opened back in 2015, okay? The energy corridor, as you can see, had a good bump in property values as the economy recovered after the housing crisis, but after that, it kind of hung around, right? An erosion of a job base in a place like Houston is not going to kill the housing market in the energy corridor, but it didn't help it, all right? And so that part of Houston didn't see much in the way of appreciation. That's not lift. Then you go to Cleveland, and you can see that it was down, the average price was down just under $100,000 back when that facility opened up in the Woodlands, and you can see that it made its way up closer to 150. So there was actually a 60%, 61% increase in the average property value in Cleveland, Texas in the last 5 years. That's lift. That's it, okay? This is very, very common sense. If you understand people, why they go where they go, what the reasons are why they go there, are they going to continue to go there? Is it going to attract people? The answer is yes. And now here's the sugar on top, or the icing on top. This is all happening before COVID, and now it's all accelerating. Right? The big takeaway for me with the COVID experience is that a whole bunch of things that were already happening are just accelerating. They're happening faster. All right. And it's across the board. People leaving New York to go down to Florida. We're getting 10 years worth of that migration inside of 1 year. People leaving closer into the city, or people who are working in the city who are no longer going to commute to an office in that city, going out and making their way out to the exurbs. Noel has been identifying that second home markets all around the country are changing from being second home markets to being primary residence markets. I mean, he lives in Steamboat Springs, Colorado, right? There's no jobs there except for through his Zoom camera, right? But he's seeing that tipped him off, and now he's noticing everywhere that second home markets are catching on. All this stuff is happening more quickly. Amazon is eating Macy's. They were already doing that. It's just happening faster, right? So COVID is the great accelerator of sort of mega trends in population and demographics. And that benefits these places that are these outlying suburbs that when you see a 61% increase in property value in Cleveland, Texas, before COVID, just because of the natural migration up that way and the things that I've talked about with the changing landscape and the Woodlands employment base, now that's all going to go faster. All right, so when I'm done in about 5 minutes, Noel's going to jump in and actually show you brand new homes that we have got listed here in Cleveland that have tenants in place. I told you when I opened up that we want this to be an actionable show, all right? So we share really fresh market intel that was gleaned from a combination of data analysis and boots on the ground research, right? The NSA and the CIA operative on the ground, right? If I want to self-aggrandize our team here. That then translates to small batches of brand new homes that we are being given the chance to sell. And that's important. They're small batches because this stuff is selling so fast that builders are actually reluctant to carve any out and give them to us. So they give us small packages of these things. I think we have 17 in Cleveland, Texas. I think they're going to be gone relatively quickly. In fact, since we launched this program of working with new builds, we call it RWSelect. It's a selection of brand new homes for investors. We had 1,700 properties submitted to our program by builders since the end of May, and they all sold by the end of August. 1,700 houses. We didn't sell that many of them. okay? Because the builders had such a rush of activity coming into them that they were selling these houses like hotcakes to John and Jane homebuyer. So that's who investors are competing with. We know that. They're rabid right now to get these houses because they want to get out of the city. And so these are short-term opportunities that we're trying to tee up for you, explain them for you. And if you're interested in pouncing on them, I'm pretty sure those 17 houses are going to be gone, whether we sold them or somebody walked into the model and bought it directly from the builder. But don't hesitate if you like what you hear to make contact with Noel and take action. All right, so that's the Northern Houston. Noel, do we have anybody asking any questions yet on that, or do you see that? Are we live right now? If we're live, we can't go dead air. So why don't you unmute yourself and just say what you wanted to say? That's great. Go ahead. All right, Noel's coming on because he was muted, and we're working with this platform called Social Live, which is not as easy as running a Zoom meeting because it broadcasts live on LinkedIn. So excuse the dead air. And Noel is coming, I think, in a moment here. We have a couple of questions. It sounds like people aren't seeing the screen. I can't tell.
Let's see here. It should be all right. So I'm back on.
Okay.
We're learning to work this platform, and when I'm not on screen, I can talk to Greg in his ear, but nobody else can hear me. So what I wanted, a couple questions came in. A couple people are asking if maybe we can show migration patterns. Maybe that's something we could do on another show, Greg, and talk about in and out migration. I think that's a great idea, great subject. Also,
what I can say to that is I can't show the map right now. What I can tell you is that it is universal that people are leaving California, New York, New Jersey, Connecticut, Illinois, and making their way to Arizona, Las Vegas, everything in Texas, Tennessee, Carolinas, Florida. Again, that was already happening. It's just happening faster now. And people are also going away from the city. I know I might have mentioned that, but I think it's worth reinforcing that those two trends are happening, and Houston is benefiting from both of them, and the outskirts of Houston is benefiting from both of them. So when you see what 250 grand gets you, which I think Noel's going to show you now, up in Cleveland, I think it's pretty amazing. Actually, it's on the screen now.
Yep. So a couple notes on that too. Where we're going right now is our RWSelect website. The whole point of this is to educate and then show real opportunities. We're not in the big business. We are in the big business of selling real estate. That's what we do. We're not here just to schlep properties, but the fact is, as Greg pointed out earlier, the demand for single family homes across the board is unprecedented right now. It is unbelievable. That is pushing the yields down, but not out of reach. What it is doing is it's pushing some of the yields out of reach for some of the larger institutional funds because they're really yield driven. But when you're looking at these properties, we're really looking at the cash flow, and we're seeing a lot of 1031 exchange money, for example, coming out of New York, coming out of retail and office and multifamily, and coming into the single family rental space. And just to give a quick thing, Greg, I know we didn't touch on this as much, but there's some benefits to that, right? So you're looking at a house here that it's worth $252,000 now. What's it going to be worth in 10 years? Just based off the home value, not even talking about the income of the property. The income of the property is even, icing on the cake, or you could say the appreciation is icing on the cake, I guess.
Well, that's an important point, that the institutional investors in this space, which were instrumental in the professionalization of SFR, if I heard it once, I heard it 50 times, that you can't count on appreciation, you only buy on yield. And I understand that because they're borrowing money at a certain rate. They have to deploy it and generate income. And the people that are deploying the capital to them, they're going to win on appreciation. Invitation Homes won on appreciation. The cash flow was how they raised the capital and then gave them the staying power to wait for that appreciation. But as smaller investors, you have to be thinking about both yield and appreciation. Otherwise, like, this is not a 4.5% or 5% investment. It's a 10 or 12% investment because it's got yield and it's got appreciation. And if you look at a build wealth in a household, that's the combination that you need.
And when we're looking at the yields on these, for example, I'm going to pull this one up here. We're looking at what we call the yield on cost. It's going to take a second since we're pulling a lot of bandwidth. So the yield on cost is just, what is the yield, cash on cash, you buy the house today. That yield isn't taking into account the appreciation. It's not taking into account your tax advantages, such as cost segregation, which can increase the yield up to 3 to 4 points in the first 4 or 5 years. So there's a lot of things that we're not experts on that we'll bring some people on in the future to talk about those things, especially about the cost segregation. But we're looking at just the yield on cost and the cash flow of that property. You take into account the market, the appreciation of the market, your tax benefits, things like that. You're going to have a rate of return that is much, much higher. Most of the time when a fund looks at buying a property, on their back end model, it's different. But when they look at buying a property, they're just looking at the yield on cost. And if they need to hit a 6% yield, they've got to hit a 6% yield. So they're not buying that property if it's at F5.5. But that's leaving an opportunity for an investor to come in and buy and benefit from that appreciation, because you wait till next year, you're not going to benefit from the appreciation from this year to next year. Let
me jump in now, because there are a lot of people missing a lot of great investments because they pay attention to yield only and they don't have a good way of forecasting the appreciation rate. And so if you did that, here's a list of the cities you didn't invest in the last 10 years. Denver, Colorado, Washington, D.C. suburbs, Raleigh, North Carolina, Austin, Texas. The list of markets that are off your list now: Nashville, Tennessee, Charlotte, North Carolina, off your list. Why? Because they dip down into the low 5s or high 4s in terms of yield. But if you're a small investor and you're not locked onto a strategy that you use to raise capital, and you're looking at having this investment plan coalesce over time to create wealth, what you're doing, for example, in Cleveland, you're looking at this thing through the prism of elapsed time. What is it now? All right. Yield on cost now is, I think, mid 4s to high 4s on these things. That is not setting the world on fire. Okay. It's better than you're going to get with a bond, but it's not setting the world on fire. But there's 6% appreciation properties. That's been the average over the last 20 years, has been 6%. It's been much more than I told you, 61% in 5 years. So we can't guarantee any of that. All right. But what you're doing here is trying to pick winners. And the picking winners is, what can you do if demand in that whole northern sort of exurb of Houston is catching fire right now because of the things we talked about. And if Cleveland, which was in the middle of nowhere before, is now in the center of everything for certain people, how long does it take you to push your rent up a little bit at a time until that property that you bought for $235,000 and was yielding sub 5 is now yielding north of 5, north of 5.5, north of 6 over time? You build your way to it. A lot of property managers don't raise the rents with the appreciation of the market. If your house got more valuable by a factor of 6%, it became 6% more valuable in a year, your rent theoretically can go as high as that in the following year, or at least in the trailing years. And so we've gotten really good as a company at knowing what the rent should be and not just phoning that in. A lot of people just phone it in. I've done it myself as a landlord. They're happy there. Just renew the lease, bump it $25 when I should have bumped it $75. And after a couple of leases, if I did that, I would have made it, a completely different picture. So I learned my lesson on that. But to Noel's point, you look at this thing of what are you going to do over the first 5 years of owning this property to make it yield a higher number and have that all happen while the property is appreciating at an outsized pace.
Yeah, it's interesting because we're dealing with, lately in the single family rental space, investors, a lot more commercial real estate investors coming in, and that appreciation that we deal with in single family rental and single family homes is a little bit foreign to them, because they're really looking at, okay, what is the cap rate in a market? How can we increase rents? And that's it, right? Well, you've got a dual purpose here with a single family rental, that you can benefit from the appreciation from the broader housing market, and also benefit from the appreciation of your rent. And beyond all the tax benefits and things like that. I've just been scrolling through this a little bit to kind of show this property. But so this is a property that cash flows $10,000 a year at a 4.4% yield. That's just your cash on cash. That's not talking about that appreciation and what you're going to get a bump. And so a lot of people talk about, well, how long do you need to own to really make it worthwhile? My opinion, and Greg may think different or the same, is that you need to at least own for 5 years. You're looking at something that after 5 years, if you start looking at your cash flow and your appreciation and your equity, it starts really getting more interesting at year 5. I mean, year 5, you've got $11,500 in cash flow, and your equity, you're looking at a value of a house that you bought for $230,000 is worth $310,000. And that starts to mushroom out. This is not over the years, this is not a let's buy now, hope the market appreciates 10% or 7% every year, which it probably won't. If you look at the trend line, it's what, Greg? 4%.
3.5 is the national average.
3.5 is the national average.
When you see that's really noteworthy. And again, these things play out, right? So we've been doing this for more than 10 years, looking at these factors of migration patterns. I like to call it people watching, right? This all ties back to shelter over families. And if you could get a feel for what they're doing and why, and will it continue, which is what this is all about, we've been able to pick winning markets very accurately over a long period of time. So we're very confident in this. And so what I want to do is we're going to jump over to the next thing because we're 30 minutes in right now. Okay. Alabama.
So I do want to point out a couple of things really quick on this. In here is a calculator. You can play around with the numbers. We have the actual taxes based on the current value, or the purchase price of the home based on the current tax rate. You don't know what the taxes are going to be in the future, but you can calculate them for currently. We have pretty low management and maintenance costs in here because this is a new construction home that comes with, and most all of these homes, or all of them, will come with a builder warranty that warranties the construction of the house, the guts of the house, and then you have warranties on all your appliances and mechanicals and all of those things. So that greatly reduces your maintenance costs, and you pretty much have zero deferred maintenance for the first 5 or more years, and then you're going to have very low upkeep of these homes. You can always have issues with tenants and things like that. And there's some great products out there that protect you for any damage that a tenant does. And so I always suggest to do your research on that, and we can talk about that another time. But you can be pretty close to worry-free in a house like this with very minimal repairs and maintenance issues for the first 3 to 5 years. And we're taking these numbers from our institutional investors and how they underwrite these homes. When you underwrite, when you use assumptions to get financing, sometimes the banks are going to have you push a higher number to get that financing because they want to hit certain debt coverage ratios. But the actual costs of what we think it should be are here. So you're looking at a house that you're getting a return on your investment 11.4%, 4.4 cash on cash, but it cash flows $10,000 a year. And what we're going to see the difference is, Greg, you want to go to the Alabama properties?
Yeah. So I'm going to jump off my screen and share what I've got on mine.
Okay.
All right. Yeah. So let's jump to that. I'll give it 3 or 4 seconds. While I'm doing that, I'll just direct you again to RWSelect.com. RWSelect.com is our site for the small batches of new construction homes that we're bringing through this channel. All right. And so please feel free to do that. I should be, Noel, so shut your screen down for the time being.
Sure. You want to just go on show the RWSelect? Okay.
Yeah, just go full screen on my screen for now. Yep. Pop your screen off and
just give me a second to
so everybody, you can go there. Noel was just showing you, this is a site that you can go to. You can see, look at the individual properties, go in, you've got mapping of the properties, you've got interactive calculators, price appreciation, market analytics. He showed you briefly the forecasting. Okay, here I am. All right, so you go into I'll just go right into the Texas portfolio. This is into our portfolio visualizer. All right, shows you the properties we're talking about. Again, Woodlands, Cleveland. So it's right on the way. You go into these individual properties. I mean, they're really pretty. They're really pretty. And then when you go in, you've got the interactive calculators. Those calculators have projections based upon appreciation rate and rent increase and expense increase assumptions that we bake in there based upon the long-term average. But you can change them and kind of count your money and say to yourself, well, if this property is a retirement plan for me, and I'm 45 and I want to retire when I'm 65, so I've got 20 years to work with, I can use these to monkey around with my assumptions to see if this, then that, and how far do I get. And then, of course, we've got the market data, which this shows the population increase, the price appreciation increase over time compared to the state and the country, population trends. Right. I mean, it's outrageous how steep the population growth is in this county and so forth. So we try to make it easy for you to do some of the institutional quality analysis that we do with our larger clients. We really develop these techniques with them, or they developed them, and we built technology to help them. It all came about over a decade, and now we kind of just put it out there for free for everybody to use it. So that's that, RWSelect.com. And now I'm going to jump back. We're done with Houston for the time being, and we're going to go check out Birmingham. Take a little flight. I love Google Earth. So Birmingham is an interesting market because Alabama is a state that is maturing more slowly than other states in the South, right? So is Alabama the new Georgia, right? Is Kentucky the new Tennessee? Is Oklahoma the new Texas, right? All these things. The answer to all this is yes. It's just a matter of when and how long it's going to take. And as I've mentioned, I really believe we've got a lot of evidence that markets are developing at a pace now that's faster. So the map you're looking at of Birmingham, the yellow pins are the big manufacturing plants. So Birmingham, Alabama in general, has become over the last couple of decades a mecca for automotive manufacturing. You've got a big Mercedes-Benz facility in Tuscaloosa. You've got a really big Honda facility up in Lincoln and Talladega. Talladega, of course, the world-renowned race course there. And so the story here is very simple. You have a city that has not popped in terms of prices going through the roof. It's not like Charlotte or Nashville or any of the other places. It has not evolved to that point yet. But the question is the general migration down to the south, the glacial migration going down to the south, it's been going on for 50, 100 years. Is that going to continue? Answer is yes. Is it going to make its way to Birmingham? Answer, it already has. What is the anchor, the employment anchor and the megatrend anchor in Birmingham? And I believe that it's the auto industry, okay? The auto industry, like if I show you, well, two things. One, you get a little visual here of here's Birmingham, here's Mercedes, here's Honda, all right? And now here is the map. Wait a minute, am I in the right place? I might be in the wrong place. Hang on a second. I'm in Texas. I need to be in Alabama. Okay. Yeah, okay, sorry. So I went from auto manufacturing, and now here's the map of the properties that we have. Lincoln, Talladega, Tuscaloosa, or just near Tuscaloosa. So here is a really small batch, okay? But this builder is building properties behind it. So if you like the story, there's more inventory coming. These, again, are cute little houses, just working class houses. The yields are substantially higher. I'll leave that to Noel to go into. But I just wanted to draw your attention to the fact that the places where these properties are the same places where the auto industry is, which means that's who's going to be your tenant, right? You've got anchors that are driving prices up and attracting population. And I wanted to show you this. This came from a website, and I'm sharing you stuff on the browser because I want you to see that this is fun stuff if you're into it, to go out and research yourself. So I found this Alabama manufacturing facts. I wanted to illustrate a point. I found it in a matter of moments. Here is the output in billions of dollars of manufacturing in the state of Alabama. You notice what happened in 2016. It had already been going well. All right, the Honda plant, the Mercedes plant, all these things were expanding. There's other plants up in Huntsville, Alabama, where the same kind of thing is happening. Big Toyota, big Mazda, all that's going on. But look what happens in Alabama starting in 2016. It just took off. And I know you know why, right? The auto industry and manufacturing was front and center in 2016 after the election. It was a major election issue for all of these states in the Midwest. And I think you could basically say that the auto industry got muscled into bringing jobs back. Okay, factories in Mexico were canceled. Factories in China were canceled. Expansions outside the U.S. were terminated in favor of expansion inside the U.S. And a lot of trade and tariff and tax was all brought to bear in terms of pressure to the auto industry. And what you see is output went through the roof. That's not stopping. That's not slowing down. All right, these things are permanent. So that's where, so what you're seeing here is an industry that was already anchored in these markets that is now catching fire in a renewed way, in a way that I believe is sustaining. And then you've got individual properties in these places, and I'll throw it to you, Noel, to grab it from here and share. While I'm waiting for you to pick it up, I'll just show the page, and then you can take it as you grab the screen share. Or tell you what, I'll just do the screen share and you talk, because I don't even. You did? Okay.
Hold on. So keep talking, Greg, because it hasn't. Oh, now it's up. Okay. It's pulling up the page right now.
All right.
So we might have to switch. Yeah, here we go. I got it up now. All right. So the difference is the big difference about these Alabama properties. For one, this is when we're looking at the Houston properties, we're looking at properties that were higher renting properties. So they were $1,600 and up. The tenant type could be anything from a working class to a professional tenant, a professional working tenant. In Alabama, you're getting a little bit more of a working class tenant, which is great because you've got great job fundamentals in that market with the auto companies. You've got defense companies also in the areas that we didn't talk about so much. But one of the biggest difference between these types of houses is taxes. So when we're looking at that house in Houston, the taxes were $5,700 a year. We're looking at this house in Lincoln, Alabama, and the taxes are $1,350 a year. So that gives you more space to get that higher yield. So we're looking at something that is yielding at a 6.29% with a gross yield of 8.62%. So the gross yield between the Houston property and the Alabama property were almost exactly the same. And the gross yield being just strictly what is the yearly income of the property and what's the purchase price. And that calculates that gross yield. But the net yield is much higher because taxes are lower. These are they're quality homes with granite countertops. Most of them have the black appliances. Sometimes you can also, if you choose, put in the stainless appliances. It's really more about what is acceptable within the market rather than what you think should be in a house. And that's something that's really important to understand, that especially if you're a newer investor, the things that you would look at as a finer finishes on a home that you would buy to live in are not the same types of things that you want on a home that you're going to use as a rental. It's really about what is right in the neighborhood, what's right for the home, and then also what's durable so that you have less maintenance, repairs and maintenance issues in the future, less deferred maintenance in the future as well. So this is and I'm actually going to pull up the portfolio here because this is interesting when you look at this portfolio. And just so you know, this particular address here is already sold. These houses came out last week. They sold within a week, but they have a lot of homes just like this every month coming out in these same neighborhoods in Lincoln and Talladega, Brookfield, I think is the other area. So you're looking at the lower taxes, your management costs at 8%, which is about average. Very low expense ratio in this home compared to the home in Texas, which we're looking at a 45% expense ratio, where here we have a 27%. Now, Houston is probably going to appreciate a little bit faster than Alabama, but Alabama has been appreciating really well. Alabama is a strong market. We talk to home builders all the time, all over the country. And I can tell you hands down, all over the country, the homes are selling as fast as they can put them out. And Alabama is another one of those markets because of the affordability. So if you want to compare the two markets, Alabama is going to be a little bit more affordable market than Houston in some aspects, but Texas has no income tax. Alabama has an income tax. Texas has higher property taxes. Alabama has lower property taxes. There's going to be all of these different nuances between the different markets.
And Noel, let me just jump in for a second because I pulled up on the screen there. This is the price performance chart for Talladega County. And you can see the green line is the county, the black line is the state, and the blue line is the U.S. And you can see that Talladega was kind of humming along. Very interesting, the seasonality. You notice that? All right, high points are the summertime, low points are the wintertime. That everyone knows seasonality is a thing, but here you can actually see it on these charts. And what it tells you is load up in the fourth quarter. That's part of the timing of this also, is that the demand is lighter usually in the fourth quarter. Look what happened in 2016. Auto industry, I showed you the manufacturing. Where was that? Here's the manufacturing chart. Here is the price appreciation chart. All right, so we started reaching new highs. And again, they went from an average price at 100 to 125 to average prices up closer to 200, 210. All right, now why does that happen? Demand. It's not complicated. It's just demand, right?
Yeah.
So when he talks about the yields being high, you print, you set your claim, right? You get your basis at these $125,000 price points in this market, and then watch those values go up by 50% potentially over a 5 or 8 year period. But you're still anchored. You got pushing a 7% yield the day you buy it. You raise the rents as the demand increases. You get that 7% yield up over 7. At the same time, your appreciation rate stops being anemic and continues what it's already been doing, which is it starts to really crank. That's what you're watching a great southern city and the suburbs in it sort of move to a new equilibrium of value, all based upon demand. So I love the idea of balancing these kinds of things. Like for me, buying 1 in Houston and 2 in Talladega makes a lot of sense because your yield is high, but you're also going to see appreciation pressed. That's part of the value that we try to bring of being a national property management company. You could have one brand managing your properties, but you can actually be taking positions in different places based upon kind of reading these different mega trends and these different micro trends, placing your bets on different things, but blending them so that you actually achieve a higher overall. I mean, you're diversifying your investments by playing 2 different sets of trends, basically.
Yeah, and that's a point, and that's a great point. And also kind of to back on the seasonality, Greg and I have been doing this for a long time. And when we're buying for investors, I can tell you right now, the funds that we work with, we're getting into the fourth quarter here. They are wanting to ramp up their acquisitions because they know typically the seasonality of pricing, the values go down a little bit, and so they could pick up a couple of extra points on the acquisition price to help their yield. So now is a really good time to be buying, and with the advent of companies like ourselves and other strong rental companies and the rental markets becoming a little bit less seasonality. So where there is demand year around, maybe you're talking December, not as much, but we've seen this in Alabama where we purchased several hundred properties right in the middle of the winter and we rented them all out because the demand was there. People are moving right now at all times of the year, especially with remote working and remote school. People can be a lot more mobile than they used to be. So the worry about being able to rent out a property during the middle of the winter in these southern markets especially is less of an issue than previously.
All right, cool. So we're running down on time here.
Yeah.
What we wanted to encourage anybody that has any further questions, you want to dig a little deeper, Noel's contact information is right there on the renters, the RWSelect page next to every property. Next to each portfolio. Email him, connect with us, ask questions. As you said, these things are moving very quickly. So don't think of this as a high pressure sales tactic, just me being honest about the fact that these are hard to come by and we get our hands on them and we try to move them as fast as we can because it's very competitive out there. We're very excited about both of these opportunities. We think that you're going to do well if you take positions in both of these cities. The fundamentals are there, and the houses are brand spanking new. So it just becomes an easy way to invest. You don't have to do the whole buy a junky house and fix it up thing. I can't do that. I don't like doing that. I like making my money based upon the intuition and the data to figure out where the progress is moving, and then buy there before it gets fully there, and then see my values go up, not because I bought a junker and fixed it up, but because I bought a winner in a winning place, and then all boats rose with that tide.
Couldn't agree more, Greg. You have your shared screen still on, by the way, but
Right.
yeah, appreciate everyone coming on the call. Feel free to reach out, and we're gonna start doing these every week. We're gonna have a couple different things we're gonna do. We're gonna do this picking winners show, and then we're also just gonna do an SFR Pulse show. That the picking winners is more driven by Greg. The SFR Pulse is more driven by me, which is kind of what we are already doing anyways in the content that we put out. And we're gonna be doing a lot more of this. So I really appreciate everybody coming on. Something happened on LinkedIn, Greg, which was interesting, is we had 54 people and it went down to 1 all of a sudden. So I don't know. Sometimes there's glitches with that. So I appreciate everybody coming on.
Yeah. Hey, thanks for being here. Hope you have a great weekend. Noel, good job, partner. Always a blast.
Thank you.
All right.
We're just going to put it on the splash page here for a few minutes to let the recording sync out.
Peace
out. Thank you. One second. Well, it's trying to switch over. So if you're still watching, appreciate it. I'm going to let this, I'm watching the live feed, Greg, to let it cycle through the end. And for some reason, it's not letting me send. Oh, here we go.